Good morning, everyone. So now we'll start our 11:15 Monday morning webinar. So today we'll have an update for UOB before the results in May. We have Capital and Commercial Trust, SREITS, US Weekly, China's Weekly Musing, and as well as our Singapore Weekly. So first, we will start off with UOB's update. So for UOB, the main thing is the interest rates for this quarter. So for interest rates, we still maintain that the lag effect of interest rate pass-through will still translate into the net interest margins expansion in the upcoming quarters. So there will still be room to rise in the next 3 months. And with a pause in rate hikes, now is probably the best and the last time for the banks to hike their board rates, and as well as repricing their loans before interest rates start to tail down. And secondly, net interest margin will be supported by the increase in board rates. So net interest margin growth will mainly arise from your mortgage loan book repricing, more so for your retail mortgage book than your wholesale mortgage book. So this is crucial for the repricing to raise net interest margins while SIBOR and SOR is still elevated. So to put things into color, around 50% of your mortgage book could be repriced from the hike in board rates, with the full impact on net interest margins to be seen in second quarter instead of the first quarter, because most of your mortgage book need time for the banks to reprice. They don't just reprice all at the same time. And thirdly, for the CASA deposit, so recently, based on the entire banking sector statistics, your CASA deposits are actually contracting year on year every month. So the CASA ratio, which is when you take your current and savings account, add up together, you divide by the total deposits in the sector, that will be your CASA ratio. So the CASA ratio growth is actually contracting every quarter. And in a rising interest rate environment, it usually has a trend of fixed deposit increasing faster than your CASA. So this will translate into a rising cost of deposits for the banks, and this makes it challenging for them to achieve your net interest margin improvement as well. So, but we expect competition for fixed Ds to taper off in the next 3 to 6 months and funding pressure to decrease because investors do not expect any more rate hikes. So the demand for fixed D will probably die off in the next 3 to 6 months. So overall, we believe that the trailing down of SIBOR in the next quarter will be offset by rising mortgage rate, as well as when the banks reprice their mortgage loans. And also the pressure will be offset by lesser cost of funds from lesser competition for funds. So moving on to loans growth. So we all know that the loans outlook for Singapore will be weaker in 2019, and the same goes for the banks. So for the bank's mortgage loan growth, for UOB will still be maintained due to the progressive drawdown of the mortgage by your retail mortgage loans. And overall loans growth will be held up by demand from your non-bank financial institutions and your property funds. So property funds, they still have a healthy line of demand for loans for their commercial properties and their data center development or acquisition activities. So to put things into color, UOB's current market share of Singapore dollar loans and deposits is at 23% and 21%. So for asset quality, there is currently very low residual risk from the oil and gas sector. So why so? This is because the bank has already, UOB has already provided for about 70 to 80% of its total oil and gas exposure, with collaterals marked down by 90% of its asset value. And they also have conservative provisioning policies as well, where if you look at the financial statements, the aging table for their loans, you can see that for loans that have even yet passed the 90 days limit set by MAS, UOB do provide for them as well, and they were classified as non-performing loans. But this is only for certain loans defaults and it's subjective to each individual loans. So for dividends wise, all three banks as of FY18 results have similar CET1 ratio of around 14%. And we believe that with such robust CET1 ratios, the banks can maintain their current dividend payout policy. So for UOB, the current dividend payout policy is for full year dividend payout to be at 50%, subject to a minimum CET1 ratio of 13.5%. So as of FY19, we forecast our DPS for UOB to be at $1.26. And we forecast UOB's FY19 dividend yield at 5%. So the latest few things that happened for UOB, firstly, is the Prudential deal. So they renewed their bank assurance deal with Prudential on January 2019 for 15 years for a sum of 1.15 billion. So this 1.15 billion income will be amortized evenly over this period. And the second thing that happened for UOB is the digital bank in Thailand. So the digital bank in Thailand mainly targets the middle to affluent class of the more tech-savvy younger generations in Thailand. And at the moment, their aim is just to gather deposits from them. And this was made even more possible now because of the launch of PromptPay in 2017 by the government. So PromptPay allows funds that are offline to come online and make it easier for users to transfer funds through digital banks. And UOB's digital bank in Thailand partners with the local telco companies to assess the creditworthiness of these potential customers using their phone bill payments history. So for UOB, we maintain the buy call, and we have a buy call with a local target price of $32, previously was $32.50. And this is because of us penning in a more conservative FY19 net interest margin forecast of 1.82%. Previously was 1.84%. And this is because of the rising funding pressure that we're seeing in the banking industry as well, from a steep growth in fixed deposits, while we are experiencing a very flat growth in Singapore's loan market. So our forecast of 1.82% is actually in line with UOB's guidance in the previous quarter's results. So even after achieving a record high ROE in FY18, the management still guided a higher ROE of 12% in FY19. So this shows the management's confidence in effective cost measures this year, as well as backed up by net interest margin, and lower provisions this year should also provide further upsides to earnings in 2019. So we forecast earnings growth of 7.6% and dividend yield of 4.7% in FY19. So next, I'll pass on to Natalie for Keppel DC Reit.
Hi, good morning. So today I'll be presenting on Keppel DC's first quarter 2019 results. On a year-on-year basis, gross revenue increased by 10 million or equivalent of 26% due to the contributions from newly acquired Keppel DC 5 in Singapore and Maincube DC in Germany. These two assets were acquired in the third quarter of 2018 and the second quarter of 2018 respectively. The distributable income rose by about 30%. This margin is greater than the increase in gross revenue, mainly due to the lower cost of financing from the medium-term notes issued, as well as tax savings of about 500,000 from Keppel DC 5. So the lower interest cost from the MTNs is due to the lower Euribor. On the positive side, the portfolio occupancy was maintained at about 93%, and the portfolio has a long WALE of 8 years. The cost of debt, as mentioned earlier, fell to 1.7% from 1.9%. This still leaves a comfortable debt headroom of 273 million. The revenue, we expect revenue uplifts from AEIs on pre-committed leases and increase in power utilization from Keppel DC 3 and Dublin 2. So the AEIs for Keppel DC 3 are to increase the power wattage for a particular client. This will lead to higher revenues from increased power. For Keppel DC Dublin 2, the AEIs are for fit out for a client, and this will increase the occupancy from 90% to 100%. The last AEI, which is not mentioned on the screen, is for Keppel DC 1. The asset currently has occupancy of about 61%. So post AEI, which will cost about 20 million, should help to increase the occupancy at the asset. On the negative side, we note that Keppel DC's KL data center, which is Basis Bay, still has troubling occupancy of about 61%. We like Keppel DC because of the growth that the company has. The growth is mainly due to inorganic acquisitions. So as you can see from the table, the chart on the left, the Keppel DC actually enjoys growth of about 20% to 40% due to inorganic acquisition growth. The outlook for Keppel DC this year, we can expect acquisitions this year, but these are mainly from off-market deals from third parties. This is despite there being no deal flow in the past 6 months. So this pipeline is actually from the management's efforts. The management has also shared that there is still strong local demand for data centers, which is driven by hyperscale cloud players. As such, we maintain our accumulate call with a higher target price of $1.59. This is up 7 cents from our previous target price of $1.52. We raise our target price due to revenue additive AEIs secured by pre-committed leases and a lower cost of debt. So at this target price, we expect a 13.3% yield. I'll move on to Edmund to present US weekly.
All right, thank you, Natalie. So right now I'll cover the US macro for last week. So for the macro last week, there was a 0.1% month-over-month decline in the industrial production, which contracted 0.3% annualized. As for Q1 2019, the manufacturing output contracted by about 1% annualized. Sorry, almost reversing the modest 1.3% gain in the previous quarter. As for the trade deficit, it declined slightly from 51 billion to 49 billion in February, mainly due to the volatile jump in the civilian aircraft exports and a more subdued gain in imports. There was a 1% rebound in the control group retail sales in March, whereas the control group sales expanded by 2.6% annualized in Q1 2019. So overall, the retail sales figures add to the slightly more positive tone of the recent data and provide some comfort that the economy isn't falling off a cliff, but that still don't change the view that there's the fading of the fiscal boost and the lagged impact of the Fed's monetary tightening will push GDP growth to be lower for the upcoming quarters. So for the past 2 weeks, most of the largest US banks have released their earnings results. So these are some of those common themes that we have seen so far. Most of the banks have reported quarterly profit and revenue that exceeded the analyst expectations, while Goldman Sachs and Citigroup both missed estimates on their revenue. We see moderate loans growth for Bank of America and JP Morgan, while there's a shrinking loans growth for Wells Fargo. We also see a modest expansion for the net interest margin, whereas for Bank of America, it expanded 9 basis points. There's also a sharp decline in equities and bond trading revenue, whereas the charge-off rates and provision for loan losses remain at low levels. So for the week ahead, some of the key indicators to be released will be the existing home sales, mortgage applications, durable goods orders, and GDP growth rate. So these are the list of earnings results released for the month of April. So right now I'll pass on my time to Jie-Yuan.
Thanks, Edmund. China last week, we are seeing the better than expected Q1 figures. We are thinking it's thanks to the improvement of the March data. The first quarters of the 2019, China GDP growth remains steadily at 6.4%. Compared to 2018's the Q1 figure, which is 6.8%, whereas since the channels are facing the downturn pressures. In the different categories, we are seeing the accelerations in the industries to offset the slowing down in the service sectors. We are thinking this may be the seasonal reasons because it's after the Spring Festival, the China companies has starting to manage production. We're also seeing the growth in these reasons. We are seeing the growth in industrial value add jumped from the 5.3% to 8.5%. Also, there is a modest rise for the retail sales, boosted from 8.2% to 8.7%. Although there is facing downturn pressures, we are thinking with the credit growth and accelerations, the China's economics we are still positive on the China's economic. For the stock recommendations, our Hong Kong research teams recommend HC Group. In the report, and although the Q1 annual Q1 result less than expectations, we're thinking because of the business models transformations, it will still give the momentum for the companies to stock momentum for companies growth. In these reasons, these give the target PE ratios to 22 times, giving the target price to 5.78. In this week, we are waiting the result of the most Chinese bank and the brokerage companies. Also, we are waiting for the result of the Guizhou Maotai because on the early Aprils, on the highlight of the Guizhou Maotai result, we are seeing the net interest is beat expectations. This is a list of the companies who are released this quarter's results. This is a list of Hong Kong stock recommendations. We added the HC Group at the target price at 5.789. I will pass to Paul for the Singapore Weekly.
Okay, we'll move on to the Singapore. Our Singapore Weekly updates. In terms of Singapore, in terms of the macro, at least for Singapore. The numbers are pretty bad, especially for the Singapore exports. I think our exports fell to a 2-year low. The large part of it was due to a collapse, almost 1/3 collapse in the electronic exports. In terms of US macro, continues to see a positive data, especially such as the retail sales. I think for last week, at least the key macro feed that we got was mainly from China. I think we see across the board recovery in the data. As you can see from here, some of the key indicators that people watch for, we start off with the investments. You can see that investments is beginning to recover after several years of decline. We also see a pickup in industrial production last month, and also in terms of liquidity, we see this from after a steady state. It wasn't really moving in terms of the 2016 onwards, 2016, but we in 2017, but we saw a big pickup in terms of the liquidity dispersed into the economy, in terms of loans dispersed from middle of 2018 onwards. Retail sales, as you can see, has been decelerating since February, but you can see that there's a sharp pickup at least for March. So most of the data shows that at least from China across the board, we're going to see some recovery in the economy. In terms of corporate news, we don't really cover Genting Singapore, but because we did attend the AGM, just to give you some flavor of what were the key things discussed in the Genting Singapore AGM. The first one is, of course, the Japan IR or integrated resort. There are 3 cities at least discussed right now that's opting for integrated resort, but it's probably Osaka is the most concrete. In terms of news flow, you probably expect any announcement of a Japanese casino, at least the result of it, the winner of a bid will be probably mid-2020. Overall, we did see at least three challenges for Genting Singapore. At least, firstly, in the near term, as you know, there's going to be a 50% hike in the admission fee for locals, effective of 1st April. management did not comment on what's the impact right now because they say it's still early. In terms of the medium term challenge for them is the 4.5 billion capex that they need to spend, and of course the 3% hike in gaming tax because the moratorium on the gaming tax expired in March. So this will be effective March 2022. More pertinent was the longer term challenges that was mentioned. They did mention that longer term global gaming revenues are down, at least for this year. And also the problem is that this form of entertainment, at least casino entertainment, is actually shifting away to other new forms, and this cannot be avoided, such as sports betting. So this is a longer term challenge, and that's why you need integrated resort to actually draw some new blood in terms of casino or gamers and casino and participants. And also you need to grow the non-gaming revenue as per what is happening in Las Vegas. In terms of our view, tactically, we still think that the market will still rally, I think, as global data continues to improve incrementally. And just one other point was that what we see is, we probably see, at least from the US, some soft landing similar to 95, 97. This is a bit complicated chart, but anyway, what we see, you can see that the blue line, whenever we have a hike in Federal Reserve rate, that it has led to a recession in the US. That's why the market was very worried when we had this Fed hike. And what you notice is that there was a similar Fed hike from 3 to 6% in 1995, but 94, 95. But actually, what had happened was that actually the economy had a soft landing. And that was because they actually reversed stance quite immediate. So that's why we're probably looking at this kind of scenario for the US economy. Okay, in terms of key events, actually the big one will be probably in early May, which is Bandit, which is supposed to be when the trade deal resolved. No timeline has been given, but that's supposed to be the time where mentioned by Trump that this will be the timeline where some resolution will be made. Okay, end of this Friday will be the US GDP numbers. Okay, that's the end of our webinar. Any questions? Yeah, thank you.
Hi, if there's no other questions, we'll end the webinar for today. Thank you very much for joining us.